In this video, we're going to talk about, should I bother researching stocks when an expert can do it for me? Good question. Stay tuned. Hey traders, a very warm welcome to you. So this is a really good question from a viewer, from a subscriber. Thank you very much. Always welcome your questions and comments as always. Interesting one. Should I bother researching stocks when I can get an expert to do it for me? In other words, they're looking to, I guess, invest in a portfolio or take a portfolio of stocks over a medium to long term. This wouldn't be probably from a trading perspective. And their sort of argument is there any point in me doing all the research, all the legwork, learning not only how to pick my stocks, but and also how to enter, how to exit, how to manage, how to allocate, risk management, all that kind of stuff, when I literally could pay an expert, and I put that in inverted commas, to do it for me. So let's have a look at it. Let's investigate it. Let's see what we think the actual answer of that is. So we've got pros and cons for both sides of the coin. The first big one, before we kind of drill down into these, is, how are we defining an expert here? So we're defining an expert as someone who is hedge fund manager, investment manager, or someone who's running a fund or portfolio as a professional, proper entity, proper hedge fund management, investment management company. Not some guy who says he can manage your portfolio for you. That's not an expert. We're not talking about that. We're talking about the proper guys who you deposit money with, and you normally have a lock-in period of a certain amount of time that you can take your money out, but there's a penalty for it. They charge you a management fee generally every quarter or every year, and possibly a performance fee if it's a hedge fund, depending on the arrangement. Various permutations and differences on that model. And ultimately, you're hoping that if you deposit your money with them, they're going to grow it for you. You're trusting them to invest it in the right stocks to give you the kind of return that you're looking for based on your risk. And it's a perfect thing to dive into here. They've got a risk profile per fund. So in other words, when you go and speak to a fund manager or an investment manager, they're going to say, hey, do lots of due diligence and research on your risk profile and say how sort of risk tolerant, risk averse are you from a scale of 1 to 10, or whatever it is. I'm not sure exactly the process they do, but they have that process where they kind of find out how much risk you can take, and then will allocate money to the fund they think is kind of most in line with your risk. So if you're not very risk tolerant, they might say, well, we're still investing in the stock market, which is inherently risky, but we have this blue chip fund, which is companies that have been around for years and years and years. We try and get dividends from them. These aren't very volatile. So unless you're unlucky enough to be at the top of the market and we have a crash, the kind of drawdown shouldn't be too much over a 20-year period, or however long you're looking to invest it for. The other side of the coin is they might say, hey, you're very risk tolerant. We've got this other fund, which we're investing in tech companies or investing in, companies that potentially could be all or nothing kind of things, and we can allocate capital to that. Or they might sort of split up the capital between the lot of them. So the problem is you've got with the expert is they've got a fixed risk profile per fund. And if you want to kind of spread your risk into high risk, low risk, you normally have to kind of allocate assets to multiple funds to do that, which there may be a cost involved in having multiple funds as opposed to one big fund. So you've got to be careful of the risk profile per fund. Whereas if you're doing it, of course, you can choose any stock you like. So you can use any strategy, any company. So in other words, if you have you kind of say, I want some growth, I want some dividends. You might play some dividend stocks, a little basket of dividend stocks. But on the other side, you might say, I'm going to pick some kind of 10 baggers, potential 0 to 10 baggers. Maybe it's going to be an oil exploration company, a pharmaceutical company, looking for FDA approval on something, anything like that, where it's kind of all or nothing for the company. And you might decide to allocate some capital to that. And of course, you can do that with your own risk and your own judgment. And one thing to point out, guys, is that if you're trading with a fund, they're not going to be able to pick the small ones, because if they've got a big fund, they've got to allocate all that capital into that trading idea or that company. And if a company is relatively small, they're just not going to be able to do it. So they're probably really restricted to a certain number of stocks that can take that kind of volume and the risk profile for the fund. Whereas you can say, I'm going to stick 5 grand in there, 10 grand in this, 1 grand in this company, and the liquidity is not an issue for you. So you've got a much bigger universe. But of course, that's a negative as well, because if you've got so many things to look at, how do you allocate your time? Which kind of comes down to this thing, which is the fees and the time. And I'm going to group these together because they're very, very similar, because ultimately you're paying a fee because you're paying for that manager's time, that company's effort. So your fee is going to be normally a percentage or a fixed fee, and I say a lock-in period. But of course, the upside of that is you don't have to do anything. Once you've given the money to them, they're just going to manage it for you. There's nothing else for you to do apart from get your statements, and you're entrusting the management of that fund or of your money to them. Whereas you've got no fees, obviously, if you're doing it yourself, but the flip side of that is you've got time required. So you're going to have to spend the time researching stocks. If you're brand new, you're going to have to learn what you want to look for in a stock. What's your strategy? What's your style? Is it some sort of balance sheet criteria? Some sort of growth criteria? Are you even involved in technicals or not? How are you picking your stocks? So that might be a learning curve that you've got to go through yourself, and there's a lot of time required for that. And then of course, actively engaging in the trade, pulling the trigger, managing the trade, knowing when to come out, what's your plan with it, how long are you going to hold it for, do I need to watch it every month, every quarter, that kind of stuff. It's like a monitoring period as well. When do I need to readjust? When do I need to pull my money out of one stock into another? How do I rebalance my portfolio? Should I, shouldn't I? That kind of stuff comes with experience, and that's going to require a lot of time on your behalf. But of course, if you can stomach that and you don't want to pay a fee, then that's kind of a good offset. The other thing to look at is a potential conflict of interest, not in the traditional sense of, they don't want you to succeed, but, they want to grow your money enough that you'll stay with the fund and it will look good and they'll make fees, but they don't want to grow it massively and have the inherent risk that comes with that, unless they're kind of very clear that that's what the fund is, because they don't want people leaving the fund. They don't want people making huge, vast sums of money and then saying thanks very much and pull it out. They want that steady growth because that's kind of what they're looking for. So potentially, if you're saying, well, actually, I want some moonshots, I want some real big swings, then there could be a conflict of interest between what you're trying to achieve, which may be massive wealth creation and prepared to take the risk on, and what the fund is trying to achieve, which might be growth, dividends, income, whatever it may be. So just being cautious of that. We talked about the company size criteria, and also obviously the plus side of using an expert is that there's no time needed from you. So should I bother researching stocks when an expert can do it for me? There's no right or wrong answer. You're going to have to look at the time you can allocate, the money you've got to invest, the kind of risk profile that you've got, and your appetite for the research. Some people just really not cut out for doing all the research and can't be bothered, too busy, want to do other things. Perfectly understandable. It's a very intensive, labor-intensive job to research the right stocks, to invest, allocate all your money into specific investments. So it's up to you. You've kind of got to weigh up the two things. Maybe go out there and speak to a few fund managers, investment managers, see what they've got to offer. Maybe have a little start looking at some stocks yourself on something like finviz.com or any of the Reuters, Bloomberg, that kind of stuff. And maybe if you can generate some ideas that you like, perhaps you can have a go at it and see how you get on. Anyway, guys, that's it. Comments in the comment section below. If you like this kind of stuff, give it the old thumbs up. See you in the next one. Take care. Bye-bye.